So what is the secret to making money on the speculative markets? And why is it so hard? Understanding why is the most important thing you can learn to becoming a successful trader. So let's start with the answer. It's simple, really. Because if you can't do this simple thing, you will lose. Like 90% of all traders, eventually.
Alright.
So what is it? You have to make big profits when right, and small losses when wrong. I told you it was simple. So why don't you do it? So let's start with the basics. Money management. Because you will get trades wrong, and you must be able to keep trading through any bad periods. This is the basic idea only. It would be different if you were futures trading, for example. Take your total capital. Let's say £100,000. And split it into 10 equal parts. This would allow us to make 10 trades of £10,000 each. But try not to have more than 3 or 4 trades open at any one time. This would break Gann's overtrading rule. So for example, let's split our capital into 10 equal parts. When you make a trade, never risk more than about 10% on any one trade using a stop loss. So if your first trade goes wrong, which is £10,000, you would lose £1,000. So now one of your 10 trades would be worth 9,000. Take your total capital, assuming that any open trades are worth what currently 1/10 is, in this case £10,000. So we have £99,000 left. And split it into 10 equal parts, giving us 10 trades of £9,900. Keep repeating the process for each profit or loss. If you make more than your initial £100,000, you can put it into a separate account for a rainy day. Or increase the size of each trade. By doing this, you'll be able to keep trading for a very long time. So we reduce the size of the trades when losing, and increase the size when we're winning. The opposite to a gambler. So if we start with £100,000, how many trades can we make before we lose 10% of our total capital in a worst case scenario? To make it simple, we will only trade one item at a time. To get below 90,000 it will take 12 consecutive bad trades. So what does this mean? If you make one big profit of say 100%, you have made all your money back. A common question I get asked is, how many trades do you get right from wrong? The question should be, how big are your profits compared to your losses? Most traders make big losses and small profits. Game over. Day traders make small losses but only small profits. Game over. But your broker will love your commissions.
Hello, hello, hello.
You have to make small losses and big profits. Now you have a fighting chance. The most critical thing. Stop losses. It is extremely important to know where to place stop losses. If you place stop losses in random places, you will just get randomly stopped out. So remember, you have to make small losses and big profits. You can't always make big profits, but you can always make small losses. One big profit can overturn lots of small losses. Big losses cannot be recouped by small profits. You can get over 80% of your trades wrong and still make money as long as you make small losses and big profits. You can get 90% of your trades right and lose a fortune if you make very small profits and very big losses. Small losses. Where is the best place to put your stop loss to make a small loss?
This could be useful.
Obviously below where the market bottoms out to buy. And above where the market tops out to short. If you don't get the market turning point, what's the worst that can happen? You make a small loss. Big profits. Where do the biggest market movements take place from to make the all-important big profits?
Oh, I get it!
The same places. Accepted cliches. A phrase or opinion that is overused and betrays lack of original thought. The trend is your friend. Hindsight is a wonderful thing. Is the trend about to change? Can you make a small loss? Or will your stop loss be in a random place?
Damn it! Hell with it!
House wins, you lose. Never catch a falling knife.
Why did you do that?
But to be a success, you need to find turning points in the market. That's why it's so hard. So, can it be done? Now I hope you got the idea. To be a success in the long term, or even the short term, you've got to try and take small losses when you're wrong, and you've got to try, if possible, to make big profits when you're right. Now obviously you don't know that something's going to be a big profit until the actual movement's finished, but you've got to use rules that assume that you're going to make a big profit. That sometimes means that you'll end up breaking even, it sometimes means you'll take a small loss, but you've got to try and stay in trades. It's the hardest thing in trading. Now I thought what I'd do is actually show you some of my signals that I've given and actually traded myself, and talk about my thinking at the time, why I put my stop loss in certain places and why I got in at certain places. Now we actually use, once we're in a trade, and actually entering a trade is by far the hardest thing, but once we're in a trade we just follow Gann's stop loss rules. Now Gann didn't actually have any stop loss rules to speak of. He talked about how far you should put a stop loss, but he never really mentioned it. However, he did talk about it in something he called his mechanical method for trading, which I believe if you actually followed you'd lose a fortune. But we actually use his rules there to move stop losses, and also some other rules he used for moving stop losses. And it's all based on this red and green line that you can see on the chart, and what we're looking for is where the line changes from red to green to move stop losses. Now this rule will not work if you randomly enter the market and you don't get big movements. It will only work if you find a turning point in the market, for example here, okay, and if you follow his stop loss rule or his mechanical method, then basically in this particular case you'd either get stop lossed out here or you get stop lossed out here. In fact, no, sorry, that's wrong. You get stop lossed out here. So basically you've got to get a big movement for this rule to work. You've also got to enter the market at the right time where the market changes trend. Without being able to do that, it just won't work, so bear that in mind. So what I'm going to do now is I'm going to play the last loss that I made, which was back in March, and it's now it's now November, and go through the reasoning. Now this is the Dow Jones 30, and it's to go with a training video of the 2nd of the 3rd 2016, and I'm still watching this long standing level for a possible short, but I'm also watching this level here. If you want to pick up my chart, it'll be KJ91 by GS. Now you might have noticed that I gave the signal on the Dow, but I actually physically traded the S&P, so we'll follow this one. The S&P goes down, the Dow goes down, the S&P goes up, the Dow goes up. Very similar things. Now I gave the signal when the market was looking like this. Now if you enter markets at random times, you'll just end up getting randomly stop lossed out. So I put the signal out, and then you might decide that you're going to buy it anyway, and you buy it here because you think it's going to get here. Now I'm not saying it's going to get there, I'm using the magical word if it gets there, which there's two massively different things. Now when will I know that it's actually got there? If it actually gets there. So I don't know when it's going to get there, I don't know if it's going to get there until it actually gets there. I hope that makes sense. So what happens is, if I would have say bought here randomly because I think it's going to get there and I don't know it's going to, then this is what's going to happen to you. You might say you put your stop loss below that low, say, and the market goes up, and it comes down, then it comes down, then it goes back up again, and you know that fall might have hit your stop loss, and you'd be randomly stop lossed out. So you can't enter markets randomly. So anyway, I'm still looking for the market to get to this level, and the market actually gets to the level, it's not quite got there, here. So now I want to see some kind of weakness. Now I was actually watching the Dow to make the trade, and the Dow went through that level by a bit, and it put me off making the trade, and that's why I didn't do it the next day when it showed weakness. But I was watching the S&P and the Dow, and then I'd noticed that the Dow had actually stopped at my level. Now if the Dow would have stopped at that level, then I would have entered the market crossing the low of the previous day. The next day, but I didn't do that from what I just said. The next day has what we call an outside day, so there's nothing special. I don't like trading outside days, in this case to go short. The next day we have a narrow day. Now we've actually gone sideways there for 1, 2, 3, 4 days. Now on a daily chart it doesn't look like very much, but if you're watching intraday prices, that 4-day movement would fill the entire chart scale, and those movements would look massive, but in effect they're nothing. And that's why you shouldn't watch intraday prices. It gives you a completely wrong perspective about what's actually happening. Anyway, so I'm now thinking it might give me an opportunity to get into the market. And one of Gann's rules is to short on what's called a lower trend indicator line top. Now a lower trend indicator line top is when you have a top that's lower than the previous top. So you can see it goes from green to red, and then it goes back up again, and it goes green back to red. And we formed a lower top than that previous top where it went green to red, and then in this case it formed an outside day, which is going to become relevant in a second. But again, there's no signal to make a trade buy or sell here. Anyway, so what happened is I was going to go short on a lower trend indicator line top. Now the next day we have an inside, the same price basically, so it's probably a holiday. The next day we go up, so I'm looking for some kind of weakness to enter the market. And so this is what it looked like to me at the time without the benefit of hindsight. So we come down, the next day we come down, then we have 2 days the same, probably because of a holiday as I said before. Then the next day it goes up. So what I'm looking for is what we call a lower trend indicator line top. So if I put that green line over the top, it would actually look, so red line, it would actually look like this. So the line kind of comes down in red here, it then goes to the bottom, it goes to the bottom, it would stay at the bottom here as you can see on the other side, and then we make a higher bottom and a higher top. And so what happens is the line turns to green and goes to the top for the day. So I've got to anticipate some of these things. And so what I'm looking for is for it to make a lower top. So that would be if it did something like this. So we've made a lower top than the previous top and a lower bottom than the previous bottom, and so that would mean the line would actually do this and go to the low, and then I can put my stop loss above this high. Now that's basically what happened for about half the day. So get rid of all that. And what happened was it went down, it crossed the low for that day. I put my stop loss above that top because if I knew if it went back up again it would form an outside day, and I'm probably wrong. It's a bit like what happened back here. Yeah, it formed a lower trend indicator line top and then went shooting up probably in the day and crossed the top. So I was only going to take a small loss. I knew if it went through there I was probably wrong and I'd want to get out, and that's basically the question you should ask yourself. Where can I put my stop loss that it won't get caught, but if it does I want to get out of the market? So like I said, I got in there, my stop loss was there, and I got stop lossed out in the same day there. It's called Sod's Law. However, the question is, did I get out of the market at the right time? And if we go forward, market goes up and down, but you can see that it goes, you know, it goes up. So I did the right thing by not staying in the trade and took a small loss, whereas if I would have stayed in, a small loss would have become a big loss. It's very hard to make big losses, but it's very easy to make back small losses. So, hope that made sense. Now the next trade I made was on the German Bund, and I did a video on levels that I was interested in on the 9th of March 2016, and basically the chart looked like this. Now I didn't put it out as a focus signal, which is like these summary videos I keep showing you. There was a few places I was watching it. It really depended on what it did when it got there. It wasn't absolutely stunningly brilliant, but some people want to trade a bit more speculatively than I did, but like I said, I actually did this. So one of the places I was watching was this percentage and this angle, and again, because angles travel in time and price, it depends if it can get to the angle and the level I'm watching at the same time. If it was to go sideways or up and then come down, it's impossible for it to get to these two places at the same time. So when I did the video, it looked like that, and the next day it went up and then came shooting down in the day and formed an outside day. It got to my level and got to my angle, so I was now watching for some kind of strength. Now the next day we formed an inside day, and inside days can be critical for changes in trend or a continuation of the trend, in this case down. If it would have gone and broken the bottom of the inside day, then I wouldn't have been interested and that would have been the end of the signal. But if it was to break the high of the day that it broke out and we've got a good reason to make the trade, then I would be considering doing it, and that's what actually happened. I actually got into the market when the market crossed this high here, and sod's law, the next day the market came shooting down, but I placed my stop loss just below this percentage. It was roughly about there, but I'll put the contract notes on in the video. Now the next day it goes up and you can see the line's now gone to green. Now you can move your stop losses too soon, so I decided not to move my stop loss below this new trend indicator line bottom where it's gone from red to green. Now the next day it gapped up and I moved my stop loss from below this low to below this low to reduce my loss if it went against me. Next day it went up. Next day it formed an outside day. Now I don't like moving stop losses on outside days. You can see that the line went from green to red and then had an outside day in green. So you can move your stop loss below the low, and I would use it if I was in really good profit and protecting a really good trade. But we're still not making very much money out of it, and I want to try and stay in a good trade. So let's see what happens. Next day we go up. Next day we come down in red. And the next day we go up in green. So we've now formed a proper trend indicator line bottom where we go down in red and up in green. So I move my stop loss from below this low down here to below this low down here. Next day we have a repeated price, so it's probably a holiday, and again the next day we go up and it's in green, but my stop loss is still below this low. You've got to try and stay in good trades. The next day nothing really happens. Next day we come down in red. Next day we go back up and we go back to green, so I can now move my stop loss from below this low to below this low. Next day we're up. Next day we go shooting up. Next day we come down in red, but my stop loss is still below this low. And again, if you're watching intraday prices and you've seen all these movements in here, that it just gives you a completely wrong perspective about what's really happening, and you would probably get stop lossed out every time there was some what looked like a big move that wasn't really a big move. Anyway, next day goes back up again, so I can now move my stop loss below this trend indicator line bottom to the new next trend indicator line bottom. Next day we have an inside day, then we have an outside day, but my stop loss is still below this low here, so it would nearly get caught, and the next day my stop loss is caught here. So the question is, did I get out at the right time? So the market goes up and then comes down, so I got in at the right time roughly and I got out at the right time roughly, and so that's how I get out markets. I just follow stop losses, trying to stay in the trade as long as possible. Now it takes a fair amount of courage to trade against the trend, and it's a great reason why you should never listen to the news, you should never read newspapers, because it will stop you from doing the right thing at the right time. Now I bought the pound against the US dollar next. Now we just had the massive fall in the pound against the US dollar, this huge fall because of the Brit exit, and basically I gave all this level as a possible buying opportunity. So let's play the video that I did then. Now this US dollar against sterling, and let's go with training video the 28th of June 2016, and as discussed in there, I'm looking for a possible short here, as long as it can stop pretty much exactly and show weakness. If you want to pick up my charts, it'll be MS146 by GS. Now I gave the signal on the US dollar against the pound because if you've seen some of my other videos on YouTube, you'll see that I keep saying that the angles work far better on the US dollar against the pound. However, you can't trade that, you've got to trade the pound against the US dollar. So this is the chart inverted. So let's see what happens. So I'm looking for, this is the level inverted that I was looking for in the signal. So it has to get to the level and show some strength. So the market goes up, comes down, goes sideways, comes down, and then comes shooting down to my level and actually breaks it by quite a bit, which initially had kind of put me off. However, I was still watching it, and then the next day we go up and we form a trend indicator line bottom, and I decided to enter the market, and I got in somewhere around about here. So now the market then, and I put my stop loss below that low there, and then the market came back down again in red, then we went back up in green, and I think I moved my stop loss below this low here because we formed a trend indicator line bottom to reduce my loss if it went against me. The next day we're up, but my stop loss is still below here. We've got to try and make a big profit if possible, so we've got to presume that the market's going to have a big movement even though it might not do. Next day we had another movement. I can't remember if it went up at the end of the day, I think it did, and on that day I moved my stop loss to break even. My break even point was there, so I moved my stop loss to there. I spread bet, so basically what it means is I do a guaranteed stop loss, and that means I can't lose no matter what. Now psychologically, once you can't lose anything, you'll find you'll start watching it all the time, yeah, but you shouldn't be watching intraday prices anyway, regardless if you're making money. Next day we have another big movement. Next day we have a very narrow day. Next day we come down in red, but I haven't moved my stop loss. I could have moved it below this low here on the trend indicator line bottom, but can you see it's an outside day? So like I said before, I don't like moving stop losses on outside days, and also you can move your stop loss too soon and get stop lossed out before the movement takes place. The next day we go down, so there's nothing to do. The next day we go from red to green, so we formed a trend indicator line bottom, and for some reason I didn't move it that day. And then the next day it came down because I wasn't really making any money. It wasn't really worth get out basically. And the next day we have an inside day. Next day we have an outside day, so there's nothing to do. The next day we go up, and the next day we go up, and I actually moved my stop loss on that day below this low here, just so I made something after being in for such a long time. These are the kind of movements that you've got to try and stop trading. It's alright if you do it at the right time, but if you start trading when the market starts doing this, you'll fail. Yeah, you need to know when to stay out of markets. It's incredibly difficult, all this, and anybody tells you it's easy is a fool. Next day it goes up. Now the next day we have an inside day, and that can be critical, as I've already mentioned, one way or the other. If we break to the downside, that wouldn't be a good sign, especially when we've already made two bottoms at the same level. You tend to find that if you go to the same level for a third time, then it tends to break through. Gann said it was a good sign. You call it a triple bottom. I found exactly the opposite. Gann said if you go down to a fourth time, it usually breaks through. That is true and works extremely well. So if it was to break out the inside day to the downside, then I'd be glad to get out. If the market breaks the upside, then I'd be happy because we'd be breaking out of an inside day to the upside. It doesn't mean it's a buy, it just means I'd be happy. And the next day it does actually go up, and if I would have had a really big movement on that day, it would have been excellent. But I decided to move my stop loss below the inside day on that day. Next day it went up, which is the 6th day, and there's nothing to do. But if it goes up on the 7th day consecutively, so making higher tops and higher bottoms, which you can include an inside day in that. Then I'd move my stop loss below the 7th day using Gann's 7 to 10 day rule. However, the next day it comes shooting down and I get stop lossed out here. So did I get out at the right time? Well, was I right about what I said about 3 bottoms at the same level? Well, yes I was, because it went down. And in fact, basically, it went below where I bought it, and I would have now been in a loss if I wouldn't have done what I've shown you. So I didn't make a lot of money out of it, but I probably did as well as I possibly could due to the circumstances of trading sideways. And in fact, recently, the pound against the dollar has been trading sideways. It hasn't been doing much. As I keep saying, you've got to try and keep out of these movements. And then we go back up again off the level that I was watching, and but I didn't buy it. I've already done it once. And then we have the big fall down here, and we have the other big fall in the pound against the dollar. Now the next trade I made was in the euro against pound sterling, and I actually gave the signal back here back in the middle of June, saying that if the market could get to here, which didn't seem very feasible at the time, it could be a possible buy for the pound mathematically. So let's see what happens. And that's the euro against the pound. Let's go with the training video of the 15th of June 2016, and as discussed in there, looking for possible shorts here and also here, which is probably the better one of the two, and there's a long standing signal down here from the training video of the 23rd of the 7th 15 for a possible buy here, but that's a long way off. If you want to pick up my chart, it'll be MS686 by GS. So the market comes down, so I'm not looking to buy, I'm not looking to short because I don't know. The market then goes shooting up because of the our so-called exit from Europe. Then we have an inside day. Then we go back up. Now I'm not interested in buying, I'm not interested in shorting. Never ever ever trade the news. By the time you hear it, it's far too late. Then we have another rise up. We're getting close to the level that I'm interested in. Now, what is the trend? And if you remember at the beginning of this video, we were talking about the trend is your friend. Now, if you follow that adage, then basically you just buy the euro against sterling. However, you're never ever it's never more dangerous to trade something with the trend, because unfortunately trends change, and so it's just a stupid thing that people say that makes common sense in their heads, but they don't really understand what they're talking about. Anyway, market comes down, but the trend is still really in favour of the euro. I don't know at this stage whether to buy or sell. The market then goes up, and it goes up for 1. This is the first day, 2, 3, 4 days consecutively. Then it goes up for 5 days consecutively. Then it goes up for 6 days consecutively, and then it goes up for 7 days consecutively. So we can now use Gann's 7 to 10 day rule to move our stop loss below this low if we were long of the euro, which I wasn't. I wasn't short, I wasn't long. However, one of my rules is it's a good idea not to book the trend until you've been stop lossed out of a fictional, in this case long trade in the euro. So if I was long of the euro, I would move my stop loss below the 7th day based on Gann's 7 to 10 day rule. It then goes up for the 8th day, so I'd then move my stop loss below the 8th days. So I'd still be in a long position, but I've now reached the level that I said a long time ago, at least 2 months ago, that I thought that that could be where the market might turn if it was ever to get there. And the next day it comes down, it's got to my level where I'm interested. I'd make sure my stop loss is above that level, and I got into the market somewhere around about here. And I've also been stop lossed out of a fictitious long position in the euro, so I can now go short. So the market comes down, I've got in, it then goes down the next day, it then comes up in green, and we then form a lower trend indicator line top. So I then move my stop loss above this high. The market then comes down, again, and on that second day I moved it pretty close to that top, whereas the other one was quite a bit away, it was up here. In fact, sorry, what I did was on that day I moved my stop loss. If you look at that day there, it didn't really cross that low. I think it's about 1 point below that low, that's why it went to red. But I actually did it the next day. Because of that rule I keep telling you about not moving your stop loss too soon. So my stop loss is now there. Then what happens is the market has an inside day. So breaking out of the inside day, in my case now because I'm short, would be a good sign to break out of the inside day downwards. If it breaks out of the inside day, then I wouldn't be too happy. But in this particular case, we had another inside day. So then we had another inside day, and then we had an outside day, and I actually moved and we went down a bit, and I moved my stop loss on that day above the first inside day, which was there. The next day, it went down, and I moved my stop loss a bit closer to that top that was made there because of the inside days, so I just reduced it a little bit. I think I did it, actually I did it the next day when we had that big fall. I moved it closer to that top just again to give me a bigger profit if it turned round. Now we've fallen for 2 consecutive days, where here we'd fallen 1, 2, 3, 4, 5, 6. We didn't have that 7th day for the 7 to 10 day rule, but you move your stop loss to the same place anyway. Then we go down for 3 consecutive days in red, then 4 consecutive days, then 5 consecutive days, and then it goes up in green. So we cancel the 7 to 10 day rule movement of the stop loss. Then it goes shooting up. Now if you're watching intraday prices, you'd now be panicking out of your trade, seeing all your profits disappearing, but my stop loss is there, and that's where it's going to stay unless I have a reason to move it. The next day we have an inside day, and then we go down, and I move my stop loss above that top, and the next day I got stop lossed out. So you know, he was going pretty well at one stage. I didn't get a massive movement, but you know, it's one of the biggest movements he's had, apart from obviously the big one here. You know, it was a big movement. Was I right to get out of the market at that stage? Well, the market went up. So if I wouldn't have got out, I would have made a much bigger loss, as you can see. So you know, again, I got in about the right time from a level that I calculated a long time before the market ever got there, and I pretty much got out at the right time. It would have been nice if that little inside day there, sorry, outside day there hadn't happened. It would have been 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 days consecutively. Now Gann calls it a 7 to 10 day rule, but I just carry on doing it because if you have more than 10 consecutive days, it's bound to turn. So I would have been stop lossed out there. Yeah, so that little outside day was the difference between getting out here and getting out here. Now the next trade I made was on COMEX Gold, and it was based on a signal I did on the 5th of the 10th, 2016. And the market looked like this when I gave the signal. We just had this massive fall in gold, and I was looking to buy it at this level here and this angle. This is COMEX Gold. Let's go with the training video of the 5th of October 2016, and as talks about in there, I'm watching for possible buying opportunity here, although not stunning. If you're going to pick up my chart, it'll be CO 500 by GS. Now, next day it went down, so we haven't got to level. Next day it went down. Next day it reached my level, but it didn't, or hasn't reached my angle. And if you knew what the angles were in the past, you'll see they've worked pretty much exactly in the past. So I think it also closed near the low for the day, so I decided not to do it. The next day I might do it if it goes up. Now it does, but it doesn't cross the last top, and if it would have crossed the last top, my stop loss would have to go below the angle, and I would be entering it a long way away, which is another problem. If you get too big a movement, it means that you've got to have your stop loss too far away. You can't put your stop loss in a random place, otherwise you'll just keep getting stop loss randomly stop lossed out. So I was just watching it to see if something happened, and the next day it came down. The next day it came down, and the next day it went up, and you can see that we formed a higher trend indicator line bottom because the line's gone from red to green. So I decided to make the trade here above that top, and I placed my stop loss below that low. And The next day it came down, but my stop loss hasn't been caught. It actually gets the angle, which, looking back at it with hindsight, I should have waited for, but of course you don't know whether it's not going to just quite, it's going to miss the angle slightly. I'll just go straight through, so you've got to make a decision. And then it has an inside day, so it's critical. If it was to break to the low, if it was to go below the angle, I'd hit my stop loss, I'd get out. I'd be happy to get out because I know at that stage that it was going lower. But it goes up, so my stop loss is still below this low. Then we have a big movement up, and I move my stop loss a bit closer, so I then move my stop loss on this day below the new higher trend indicator line bottom here. Then we had an inside day, then we came down, and then we went up. Now it's a bit hard to see what actually happened on that day. One of the problems with spread betting when you do a guaranteed stop loss is you've got to have your stop loss a certain percentage away from the current market price. So unless you anticipate moving your stop loss, it means that if, for instance, the market closed near the lows here and I wanted to move my stop loss would have to be right down here, and I wanted it to be closer than that. So I sometimes move my stop loss probably before I should. I usually should really move my stop loss the day after. But this is called Murphy's Law, and I couldn't believe it at the time. But basically what happened was we went up, we had a day that was very narrow, then it came down, and then that day it went up, and it looked like it was going to form a higher trend indicator line bottom. So if we put our trend indicator line on, so it went up to the top, and then it went across the top because we didn't make a lower bottom, and then we went down to the bottom because we made a lower top and a lower bottom, and so I anticipated on this day that that was going to be a higher bottom. Now what caught me out was that my break-even point just happened to be just below that low. So I thought, well, I'll move my stop loss to the break-even point, and then again, once you move it to the break-even point, you stop worrying about it and all the rest of it. The psychological part of it disappears from trading. And then what happened was there was a massive fall near the end of trading, which hit my stop loss to the exact point, and then went back up again. I think it did something like that. So it didn't break it by 1 or 2 points. It was the exact point, and usually I give it a bit more leeway than that. But just because it was my break-even point, that's why I did it. But I know I've got other clients who actually their break-even point was in a different place. But very, very annoying when that happens. Anyway, this is what would have happened if I hadn't have been stop lossed out on that day. The next day it goes up. The next day it has an inside day, so a rise out the inside day would be a good thing, especially if it's a fast movement. But it has another inside day. Then it has an outside day, so my stop loss is still below there if I was still in. Then we have an inside day. Then it goes shooting up, so my stop loss is still below that low. Then we have another big movement, so you're very happy and I'm very sad. Then the next day it comes down, and we've gone back to red, and the next day we go up and we form a higher trend indicator line bottom, and you move your stop loss below that new bottom. And the next day it comes shooting down and you'd be stop lossed out there. And then ever since it looks like that. So get in at the right time. If I hadn't just been caught out, I would have got out at the right time before the big fall that we've just had. So that's the last trade I've made. Now you might say that's not many trades over that period of time, which is true, but the trades that you can't make just because of circumstances. Now this is the Australian market. Now I live in England, and it's very difficult for me to trade the Australian market unless I want to start staying up at some ridiculous time and then watching the market, which I'm not willing to do because it's just not worth it. I can trade things in this country. But obviously I've got clients in Australia who want to trade this index, who can't trade things in my time period. So what we'll do is I'll stick in here a signal I gave on the Australian market. Now it's a modification of the signal that I gave on the 29th of the 4th 2016, so I'm still watching this level here for a possible short. However, as I pointed out in the video, it's a 0.618 retracement between the major low and the major high, and so you'll get a lot of people shorting it here. So as I keep saying, it usually means it'll probably work but not for very long and then break through to the upside very quickly, so bear that in mind. But after saying that, there's still quite a lot there, so anyway, watch the video. I'm still watching this level here. It's probably worth watching just here as well, and just using normal Gann stuff. Then this level is a new one added to what I was saying before, and the ones about buying levels in the future will depend on where the market tops out here, so I've taken those off for the time being. If you want to pick up my chart, then it will be MS887 by GS. Now it's just as important to know when to make a trade as when not to make a trade. Okay, and you also know when not to make a trade. Now I actually had a level going back a bit that I said that this here could be a possible shorting opportunity, and then I did a video where I said I'd changed my mind and I thought that this was the level it might stop out. Now one of the reasons I decided not to do this trade here is because I noticed that it retraced 0.618 between the major high and the major low. This is based on the techniques of a guy called R.N. Elliott, and you might have heard the Fibonacci series. I did it for probably 7 years when I first started doing this in the very early 1980s, when I was doing all the charts by hand. At the time, if you would have said, what do I think of it? I would have said it's brilliant. Did I ever make any money doing it? No. It's a complete and utter load of rubbish. It's the art of fitting things in to see what you want to see, especially when you're counting waves. You know, you count 5 waves up and then you say you're in a bear market, so it forces you to have an opinion. And then with hindsight, you find that it has an extension, its extension's 5th wave extension, extension's 5th wave extension, and you've just missed the greatest bull market in history, which was definitely my case in the 1980s. Okay, so I don't use it anymore. However, I do use it, but I use it not to make a trade. And when I realised that it would be a retracement of 0.618 between the high and low, that to me means it's not a trade. And what I tell everybody is, if it works, it'll work just long enough to get you in the market, and then it'll break, in this case, to the upside very quickly, because we'll be looking to short it. So what happened was, it got to the level, shows weakness, encouraging people to get into the market, and then up it goes. And the new level I gave, as you've just seen the signal, I said that it could top out at this level here. Now, what is the trend? The trend since February is very bullish, with some quite severe reactions on the way, but the trend is basically upwards. So, you know, you've got to ignore this silly notion of the trend is your friend. The trend isn't your friend, because trends change, and it happened to be the top. Okay, I then gave this as a possible buy signal. Falls of 7.1428 tend to be kind of important, so we're at a level at the moment that if it's going to go up, it could be critical. And I showed you in the previous video on the Dow that the Dow might go a little bit lower if it's going to have a rally and going up. So I just thought it'd be worth pointing out that it's at a critical level one way or the other. Now it closed right at its highs for the day this morning, so if it goes below there, then it's obviously going lower, but I'm watching it. The problem with trading this is it's from my point of view, I'm in bed, so we're not going to make a decision. So now when I saw it, it was here, and the market had closed in Australia, so I couldn't make the trade. And if this was in the British time period, I'd actually make it here. Now I'll insert part of the training video. I didn't put it as a focus signal because it actually got to the level when I actually made the video, and so it might have given me a reason to get into it the next day, but again I'd have the same problem, the market's closed when I get out of bed, so I can't make it. But it had a massive rise on that day and closed right near the high. Now I can't put my stop loss in a random place, I have to put it below this low, so my potential loss if it goes wrong getting in here, yeah, and putting my stop loss here is too big, because you've got to make your losses constant. You don't want to make them big, sometimes they're big and sometimes they're small. You want to make your losses about the same when you get it wrong. Otherwise, what you'll find is that all your best trades, so all the trades that go against you, will be the ones that you make the biggest, your stop loss is the furthest away from. That made not much sense. So anyway, what happens? The market goes up, and if you follow the stop loss rules, in fact, you'll find that you have 7 consecutive days up, and you get stop lossed out here. If you didn't have 7 to 10 days up, you would have moved your stop loss, I think it's below that low there, which is about where you get out here anyway, and then that happens to be the top, and all of a sudden the trend goes shooting down, and then I get another buy signal here. Now this is the Australian ASX, and it's go with a training video of the 3rd of 11th 2016, and sit in there. I'm looking for a possible buy here, but it really needs to fall pretty quickly to get to the angle at the same time, and I'm obviously still watching the long-term signal from July the 20th 2016 up here. If you want to pick up my chart, it'll be MS887 by GS. But on that day there, it went through the level and just went straight through, but it has gone up since. But I was looking for a buying opportunity, actually it was about there, so I couldn't do it anyway because it was outside the time period. So basically on this I said short, buy, buy. Yeah. So I can't always do the trades that I give, but some people can, obviously. Now this is the last signal that I gave on the Dow, and it's very important to know, as I keep saying, when not to be in the market, and this is a classic example. I didn't give any buy or sell signals here, I didn't give a short signal here, I didn't give a buy and sell signal in all this sideways trading. Okay, the next signal I gave was for a possible buying opportunity at this level here. Now this is the Dow future, and it's to go with the training video of the 2nd of November 2016, and as discussed in there, I'm still watching this for a major shorting at level, if you can get there, which was from the focus from the training video of the 15th of the 9th 2016, and as discussed in today's video, I'm watching this level here for a possible buy. If you want to pick up my chart, it'll be KJ91 by GS. Now notice what I keep saying about 3 times that level. It's a classic Gann triple bottom, which he said was a great time to buy, and as I keep saying, don't make Gann into a god when he was just a man with some good ideas, just like I've got some good ideas. Now it hit it once, that level, twice, this will be the 3rd time, so from a Gann point of view that's a good sign. However, I usually find you break through on the 3rd attempt, especially it breaks through on a 4th attempt, which is a Gann rule, which works very well, and this is a good example. So what happens is the market starts to go up. Now do I suddenly go, oh, I've got to get into the market? No. The market goes up again. Do I get involved in this market movement? Well, it might be the bottom, but I've got nowhere to put a stop loss. I'd have to put it right down here, and to break even I'd have to at least get the market to go up so I could move my stop loss closer. So it would just be a daft time to trade the market because I've missed it, but I don't think I've missed it because I think it's going lower. So then there was the massive fall when, because of the Trump election, goes shooting down to my level, which was in it'll be in the Far East trading, and then suddenly went shooting up like a rocket, and as of today it looks like that. So it was just completely untradeable. Outside the normal trading hours I was 100% right, but it's just one of those things. So I give a lot of signals that I can't trade, and this is a classic example of that. Now another annoying thing that stops me from doing trades that I'd like to do is that I spread bet. The reason for that is that you can do divisions of a contract. Also in the UK, your any profits are totally tax free, and you can do something called a guaranteed stop loss, which means you can only lose the amount of money you put down. So if you had a movement like you had on the euro against the Swiss franc, where it nearly bankrupted quite a few companies, and you had a guaranteed stop loss, you could only lose what you're giving them. So in reality it's probably the safest trade you can make. It's a little bit more expensive to do it, and it's not really worth doing it if you're not English. I think you can do it in Canada, you can do it in Australia as well. Also, what people tend to do is they only point out the things they get right and ignore the things they get wrong. and they usually specialise in one particular thing. So they might say, well, I only trade the FTSE, I only trade the S&P, and thinking that's a good thing because they become an expert at it. What I do is I look at lots of diverse things and looking for a few trades from lots of items, which obviously is hard work because you've got to look at lots of things. Natural gas is a good example. I've only given 2 signals on this in the last couple of years. One was to buy here, so I'll stick in the signal so you can see what I said, and it happened to be the exact bottom. Now this is natural gas, and it's an old signal which we've now got to it. If you want to watch the training video of the 8th of the 3rd 2016, which explains what I'm watching for, but I'm watching for some strength here. It's really got to stop around about here, or if it goes any probably much lower, then it's probably going even lower. If you want to pick up my chart, then it'll be CO 511 by GS. Now the next signal I gave was for a possible short at this level here. And now again, the trend is your friend is not true. You can see that when I bought it coming down here, the trend was very much in favour, so against natural gas going up. So I bought it massively against the trend. Here the trend is going up, and so I'm looking to short it, and I gave a signal for it to possibly top out if it could get to this level here. So I'll play the signal I gave. This is natural gas. Let's go with the training video, the 16th of September 2016, and I'm watching this level here for a possible short. If you want to pick up my charts, it will be CO 511 by GS. Now, this is what happened and why I didn't trade it. Now the market goes up, and eventually we're getting close to the level. So we haven't got there, and then it gets to my level. So I'm now interested in making the trade. So I went on to the Spread Better's website, and it said I could only trade the October contract. Now their contract expired before the futures contract, and it said that I think it was probably November. It said that the November contract, from their point of view, expires on the 31st of October. Yet you can probably trade the futures contract of a commodity broker until about the 2nd to 3rd week of November. So you'd have another 3 weeks. But they wouldn't let you trade the November contract until the October contract expires. So this date here is about the 13th. Now that would only give me, well, it gave me very little time. So I couldn't make the trade basically, but I know a few clients who did. So the next day we have an inside day. Now it's critical. If it breaks out the inside day to the upside, the trade's off, I'm not interested. If it goes down the next day, then it's a trade. And if I could have traded the November contract or the December contract, then I would have, in fact it was the November contract, but it expires on the 31st. So if I could have traded the December contract, then I would have shorted it on that day there. But it didn't happen. Next day as usual, we get a rally, and the next day we form a lower trend indicator line top. So another entry point, but not if it's right down here when you get in. If it falls below that low about here, would be your entry point with a stop loss above that high, because you don't want to put your stop loss again in that random place, and the market goes shooting down. Now the November contract, the December contract became the active month after this fall here. Now that rise there is the change in contract. It's not that there was a massive rise in natural gas. So if you would have carried on following the November contract, that would have been down here. But this is a continuous chart, so you get your changes in contract. But you can see that it went shooting down. Now if you actually look at the December contract where it tops out here, then you'll see that that rise didn't happen, and you'd kind of bring that down to here and it would go all the way down here. So basically the biggest fall that natural gas has had I got the bottom of the market, and they're the only 2 signals I've given on natural gas. So pretty impressive, but because of the circumstances, yeah, I couldn't make the trade because they weren't quoting for the next contract month. Now I thought we'd finish off by looking at a real-time example which illustrates a lot of the points that we've looked at so far, and it's some trades that I actually made in the late 1990s. Now there was a big crash in 1998 which was meant to be due to the collapse of a company called Long-Term Capital Management, which had this so-called fantastic mathematical formula that allowed them to predict the bond markets, and of course, as usual, it fails abysmally. And we had this big crash. Now, the best way to handle the news is by not knowing it. So it was on the verge of taking down the entire banking system. It was that huge, and eventually, apparently in September of 1998, a load of banks got together to bail it out. But the real reason that it went up in October was because it fell one of Gann's major percentages. Now, if you look at the very first YouTube video I did, which was about the very first thing I found that worked from a Gann point of view back in the 1980s, was that falls and rises of 50% were very important. In fact, a lot of the work I did was based on the FTSE. And this fall from this high was just half of 50, which was 25%. The reason the market went up at this stage was because it fell 25%. It was not anything whatsoever to do with long-term capital management. I know that sounds absolutely stupid, but it's the attitude that you've got to have if you want to be a success. If you're reading the news at the time, there is no way you'd even dream of considering buying the market at this stage, because the news has a psychological effect on you. It's by design, because the media is controlled by a few people, and they can make vast fortunes out of making you do one thing while they do another. So you can believe that or not, that's really up to you. However, these are things that I actually physically did with contract proof. Now, just a word of warning, there was, from what I can remember, there was no real email at the time where companies actually sent you when you'd move your stop loss or when you opened a trade. Basically, I was spread betting at the time because in fact that was all I could afford to do at the time, because you could do fractions of contracts. And in fact that's how my whole approach actually evolved, because I couldn't afford to make big losses. I had to make small losses and I had to try and make big profits, and it was all really down to necessity. You know, I'm not the Sultan of Brunei. I can't just go and buy something and hold on and hope that eventually it'll go up, because it doesn't really matter to my lifestyle if it went up or not, being you know, an incredibly rich person. So the market starts to go up against the prevailing news, and I was doing angles. I'd worked out what the master tie factor was on this particular item. Now, as you've seen in a lot of my YouTube videos, I tell you that what everyone says about angles is completely pointless and silly. But they always say things like the 1 by 1 is the most important angle, and if you do a 1 by 1 on this chart with the correct master tie factor, you can see it's a flat line, so completely pointless and useless. Anyway, you do your next angle, 2 by 1, then a 4 by 1, then an 8 by 1, then a 16 by 1, then a 32 by 1, and if you keep doing that and you look for kind of round about the first reaction, which is round about here, eventually you're going to get to this one here, which is 384. Now 384 is a division of 3, so if you keep dividing that number by 2, eventually you'll get down to 3. Now half that number might be important in the future, so that's a place where I'd be considering buying, and in fact it happens to be exactly to the point where the market goes and stops. Now if you did that on something that you actually lined up the exact bottom there and doubled it, you'd find you'd miss that place in the future. And then half of that is a place that's worth watching. Now halfway between this one and this one is actually 256, which is based on the odd number of 1, because if you keep dividing it by 2, eventually you'll get to 1, and you can actually see that it was exactly where the market went and stopped. So we can also watch half that number, which is 128, which is halfway between that one and that one. But notice again, it's not physically halfway. Okay, so halfway between 256 and 128, add the two together, you get 192. However, you can't add 384 and 192 together and get that number. You'll get a different result. So you need to know what you're doing. You know, as the old saying goes, a little knowledge is a very dangerous thing. Now, because I'd seen that and those had worked perfectly, I decided to make some possible trades in the future. So let's see what happens. So this was the next major angle that I was watching, and the market goes down, hits the angle again. Now, I wouldn't personally get involved the second time. It's a trend line. Anybody now who does technical analysis would draw a normal trend line through that low through there, and they would be looking to buy here. So what usually happens is it either just doesn't work, or it works just long enough to get you in, and then there's usually a very fast reversal to catch you out. So let's see what happens. And that's exactly what happens. Yeah. In other words, all these things you read in books, I think a lot of them were actually planted to put a mindset into your head to do the wrong thing. Now, I believed a lot of that stuff back in the early 1980s when I was doing this. I just assumed that the person who wrote the book knew what he was talking about. Over time, I've realised that the vast majority of them haven't got the slightest idea what they're talking about, and just basically spout off what they've actually read in other people's books, which is usually rubbish. Now, I'm not saying that's the case with everybody, but there is a lot of it out there. A lot of the software that you actually buy out there is also based on these books talking rubbish, and so what you actually get in the software is rubbish. Anyway, the market starts to come down, and it's getting close to the angle that I'm interested in buying. Now, it's got to get there, or I don't know it's got there. Yeah, so has it got there? No. Next day, has it got there? No. Has it got there? No. Has it got there? Do I here go and say, oh, it probably did get there, so I'll get into the market now? Well, you'll just lose money because you're entering the market at a random time, and you'd have to put your stop loss in a random place. So I might have missed it. Okay, so what? I'll wait for something else to happen on maybe something else, or maybe on this. So the market goes back up again, but eventually the next day, I won't show you the next day because it's but the next day it actually hits the angle exactly, and I waited 20 minutes and I actually bought it. So it hit the angle, went up, and I probably got in near the top of the actual movement, and then near the end of the day the market fell below the angle. Now, because this angle had worked exactly, and because this angle had worked exactly, and this one pretty much exactly, I put my stop loss just below the angle because I knew that if it didn't stop exactly, then I'd probably be wrong. In fact, I got in on the same day and got out. Now, the next day, that little spike down through the angle hit my stop loss. At that point, I was pretty convinced I was wrong, because every other time it works exactly, and there's no reason why it shouldn't work exactly here. So, although I was pretty upset at the time, I was glad to be out, because you've got to take a small loss. It's very easy making back small losses. It's very hard to make back big losses, and if you would have stayed in, you would have made a big loss. Yeah, then it goes back up again, and then it comes down. Now, I didn't buy on the next angle. There's actually an angle halfway between this one and this one, which is 112. And in fact, it touches the 112 exactly. Now, because I just lost, yeah, I didn't have the courage to go back into it here. But what it did, it gave me courage to maybe buy on the next one, which is half of this number here, which gave us that low there. So let's see what happens. So it works on that angle, and then starts to collapse very quickly, and it comes down to the angle. So what we're going to do now, we'll zoom in a bit closer so that we can see it easier. So as you can see, it collapsed. It went down for 1, 2, 3, 4, 5, 6 days. And one of the big mistakes I made when I was trading years ago was that I used to enter the market far too speculatively and making trades far too big for the amount of capital I had. And it was really so that I could make as big a profit as humanly possible if I was right, and take as small a loss as possible if I was wrong. Now, in this particular case, it got to the angle, but I wasn't actually in England. I was actually in Canada at a technical analysis conference at Niagara Falls, and by the time I got out of bed in the US time, and it was above the mean for the day, the halfway point of that fall, and I got in about 5,900 I think, and so I bought it, put my stop loss below that low, so the same reasoning as here. You can see here it did actually break the angle by quite a lot on the day they actually bought it. So the same reasoning, I put my my stop loss below that low, and then what happened was the next day we went shooting up. Now I can't show you where I moved stop losses, and I'm actually doing it from memory because it was a long time ago, because you didn't get the email confirmations of moving stop losses at the time. You had to actually physically ring up. Now I think on that day it went up to the top and I moved my stop loss either to my break-even point or I reduced my loss. I think it was probably my break-even point. Now once you move it to your break-even point, psychologically, as I've said before, everything becomes a lot easier, because the worst that can happen is you break even. And especially when you're doing spread betting, which I was doing, you can do guaranteed stop losses, which means no matter what happened, if the market suddenly disappeared the next day and went down to zero, I'd still only lose the amount of money that I actually put down. Next day we went up, so still happy. Next day we went shooting down and then shooting back up again in the same day, and it got very close to my stop loss, but it didn't reach there. Now I think I kept my stop loss at break even at that stage. The next day it went up, so I probably moved it a bit closer to that low, but I can't remember now, but probably because of the trend indicator line bottom, even though it's an outside day. I didn't know a lot of things that I know now then, for instance. Next day it went up, next day it came down, next day I had an inside day. I didn't really have any rules on inside days. Gann basically said not to use them, but I found them incredibly useful under the right circumstances. Next day I had an outside day, but went and closed right on the very highs for the day, and I moved my stop loss from below this low to below this low. Next day it gapped up. Now back in 1999, I followed Gann's stop loss rules on gaps, and basically what he said was that markets don't like to gap and usually come back to fill the gap, and so I used to move my stop losses below gaps. So I probably moved my stop loss below there, and the next day it went up. The next day had an inside day. The next day it formed a trend indicator line bottom, but it made an outside day to form it, which is, as I said before, not a good time to move your stop losses, but I probably did because I was in good profit at this stage. Then the market went up. Then it went up again, which is the second consecutive day. Then it went up for 3 days. At the time I wouldn't have used the inside day probably. So that's what, 1, 2, 3. Then 4 days it went up, 5 days it went up, 6 days it went up, 7 days it went up, and I would move my stop loss normally under the 7th day, but I think I got greedy and decided to just keep it below this low here. Then it went up for the 8th day, so I should have moved my stop loss below the 7th day, then the 8th day, and then the 9th day, and it should have gone below there. And at that stage I was making, I think I was going to lose £500 if it broke there, and I was doing 1.5 contracts, or £15 a point when you spread bet, and I think I was making £13,500 at that stage. So I decided, that it might go higher. Now the way I look at it, if I was going to lose £500 on a trade if it went against me, and I actually was to make £13,500, what that means to me is I can make 27 bad trades in a row to get back to where I started, because 500 into 13,500 is that. So that's why you've got to make big profits, because when you get it wrong, then you'll only lose 500, but when you get it right, your big profits will cancel out any small losses that you go and have. Now remember, I didn't move my stop loss, probably because of greed and also because of lack of experience at the time, even though I've been doing it for a good probably getting on for 18 years or so. But you learn over time, you get better. And then the market started to come down, and I think I moved my stop loss to a place where I was guaranteed to make 9,000, which is actually what I ended up making, and I'll put the contract note in here in a second. And I got stop lossed out somewhere around about here and ended up making 9,000, but I should have made 13,500. And there's a big difference between the two, obviously. But then if I would have had the courage to stay in and use trend indicator line bottoms, then I would then have moved my stop loss on this day from here to below here if I wasn't going to use the 7 to 10 day rule, which is what I decided to do. And then the market goes up again, forms an outside day trend indicator line top, comes back down again, then it forms a new trend indicator line bottom, so I'd move my stop loss from here to here. I'd probably now be making, say, £13,000, and then the next day it goes up again. The next day we have an inside day. The next day it comes down. Next day it comes down. Next day we form a trend indicator line bottom and we go up. So I'd move my stop loss from there to that low there. So we're now making slightly more than the 13,000, probably more like 14,500 probably. And then we form a potential triple top. And I think I shorted it on that day, or maybe the next day. I'll stick the contract up. Because of a triple top. Now at the time I used to believe that triple tops worked. It's one of Gann's most bearish things. Now if you're about to short something, there's not much point in staying in a long position, so I'd also probably get out of a long position, but I wasn't in because, like I said, I got stop lossed out somewhere here. You can see a triple top here, so I could see one that just happened. 1, 2, 3, and then we had the fall. So basically I shorted it, it came down, I moved my stop loss to my break even point, and I actually broke even. And then the next day it went. Sorry, I probably moved it on that day. So I probably moved my break even point, and then the next day it went up, and I probably got stop lossed out. And then we went through in a fourth attempt at the same level, which I said is something that Gann said, which I agree completely with. And so you can see, I made a small loss here, I made a big profit here, and I broke even here. And then the top of the market was actually made back here. And in fact, I actually went into, at the time we had real-time prices at work, which you put it at home now, but back then it was quite expensive to get, and I went in especially early because I wanted to short the market here. But by the time I got into work, which was about 9:30 probably in the morning, the market was already down here. So I couldn't short it because I'd have to put my stop loss above that high, and my potential loss would be too great. I mean, look at the size of that movement compared with this here. It's a good, it's a good 2/3 of that movement from there to there. And so sometimes you want to make a trade because you think it's going to top out. So the question is, why did I think it was going to top out at that level? So I showed you before that from this major high, which was the all-time high at the time, we had a fall of 25%, which is a major Gann number. Now it's not that simple. I used to think use 25s and 50s, and the secret is actually knowing when 25 is probably going to work and when it's not going to work, and that's where most of my research has been done. Now this low, as it starts to go up, should have some mathematical relationship to its future high, and so one of the levels that I'd be watching from a very basic Gann point of view would be 25%. But when it got to 25%, it just broke straight through. It gapped up through, and therefore there was no signal. What's the next major number? It's 50%. And if we look where 50% is, you can put that on, about a year before the market ever got there. It's not a prediction it will get there, just if it does, that's the time to make the trade. And so, as I just showed you, what happened was got to my level, and that's why I went in to go and make the trade, especially so I wanted to look at the prices at work. And what happened? The market broke it slightly, and then we had a holiday of some kind, which will be Christmas probably, New Year, and then the very first, in fact it's New Year, then the very first day of the New Year, after the New Year, the market collapses, and that's why I wanted to short it at that level, and it went shooting down. So I was going to make that trade as well, but because of circumstances and the fast movement as the market opened, I couldn't actually do it. And then we have, that is the top of 2000, and then we have the big fall all over for the next 3 years down to 2003 and September 11th, which was right in the middle of the fall. It had nothing to do with the market going down. In fact, if you actually look, September 11th there was a rally, not a fall. Initially there was, but it actually went up. In other words, don't trade the news. You would be tempted because of the news to short the market. The effect was exactly the opposite. So that's an example of what I'm trying to do. I'm trying to make big profits. So in this case I made 9,000, so that means that I can then get 18 bad trades of £500 each before I get back to my starting point. The chances of the market beating me 18 times in a row would be pretty slim. I'm bound to make a few profits in there, and hopefully one or two of them might be big ones. If I would have followed the rules, then I should have made 13,500, which means I could make 27 bad trades. Yeah, but you've got to stay in good trades. So I hope you enjoyed it, and if you'd like more information about what we do, please let me know.
Oh, figure it out. I'm gonna use all the power of my brain.